Hi, I'm Andrew Overman at Location.
And I'm Michael Webb at Mortgage Republic.
And together we help our viewers negotiate the labyrinth that is the mortgage maze with viewers' questions on a weekly basis. And this week's question, Michael, is very topical. I think many people perceive that we're going to see an interest rate rise as we sit here in spring 2022 with inflation spiraling. This week's question is, how does the Bank of England base rate relate to mortgage interest rates? How does the Bank of England base rate relate to mortgage interest rates? Over to you.
Okay, so there'll be two kind of ways that it can relate to it in a direct and an indirect way. So the most direct way is if you have a base rate tracker mortgage, that may be for a set period of time, 2, 3, 5 years, or for the lifetime of your mortgage. It will track the Bank of England base rate at an amount either above or below as per the product sets. So it could be that you're tracking the Bank of England base rate at 1% above the Bank of England base rate, for example.
Which and if that were the case, Michael, if the Bank of England base rate was 1%, then your interest repayment would be 2%, yes?
That's correct. Okay. So, and the change in your interest payable happens immediately on the day that they change the Bank of England base rate. There are things called caps and collars, which means that a cap is it won't go above a certain amount if the product carries this, or a collar, which means it won't go below a certain amount. Again, if the product has these terms and conditions, they don't all have that. But if the Bank of England base rate goes up again this month, you will see your mortgage payment raise this month. Now, the indirect way is that banks and building societies have to fund the mortgages somehow. Now, building societies have different regulations to banks, and this isn't the place to bore everyone with those regulations, but typically building societies will lend their own money that they have on account from savings. Okay, so they take someone's savings, they pool it all together, they give someone 0.25 on their savings, then they do a 90% mortgage at 2.5%, and their margin is the difference. Okay. Obviously, if banks and building societies have to offer better savings rates because the Bank of England base rate has increased, then if they want to keep the same margin, then the interest rates they're offering for lending has to go up. The same applies to banks that will go to the money markets, although other interest rates are involved with that, not just the Bank of England base rate. You have things like LIBOR, which is London Interbank Offer Rate, and different kinds of rates that money will change hands at on the short term that they will lend out. So overall, it impacts the cost of a bank acquiring the money to then lend out. So therefore you see the offers that are put into the marketplace become more expensive. So your fixed rate that you used to be able to get at 1.2% is now 1.8%, for example. What you typically find, and I'll be quite cynical here, is that lenders tend to price in an expected change already. So if the review is the third Thursday of the month and they're expecting a review upwards, they will start to price that in at the beginning of the month. And then you will probably see a further increase in the rates that they're offering just after that increase as well. So the consumer can be hit kind of double. What you also tend to see is that banks do not increase their savings rates as quickly to create a bit more margin there as well. So, for example, we've had a few base rate rises now. I would think most people watching this have not had letters saying that their savings interest rates are going up.
I was about to say exactly the same thing to you. We've had 3 interest rate rises, which is the first time we've had it in succession for many, many years. And my interest on my cash ISA, instant ISA and savings ISA have all remained the same.
Yep. So the bank hasn't changed them at all. They are now creating larger margins for themselves. This is just how the financial institutions work. Those rates will have to come up at some point, because otherwise raising the Bank of England base rate isn't having the effect on inflation that the government wants it to have. The idea of doing that is to take money out of the market, which makes it more difficult for people to purchase something, which forces prices down for people to get things sold. Unless obviously you're talking about essential goods, which seem to be some of the things that are dragging inflation up at the moment that you have very little control over. So if you have to pay for gas and electricity, those prices are being dragged up, unless obviously you're tied into a tariff, as a lot of people are. So that's going to be a payment shock in years to come rather than right now. Or you've had to remortgage your house to fill up your car.
Which is very much the case. So broadly speaking, do you think it would be fair of me to say that the Bank of England base rate, broadly speaking, if it goes up, we'll see mortgage interest rates go up directly and indirectly, and if it comes down, we'll see broadly speaking.
Exactly. It's if it comes down, typically rates come down when the banks start to get more competitive. So first mover, others need to follow, but very much the trend is upwards. The trend is upwards, and how far upwards it remains to be seen to have an impact on what we are now having reported as inflation rates likely to hit 8%, depending on the index used.
Brilliant. As ever, thank you for joining me, Michael. We've answered your question this week. How does the Bank of England base rate relate to mortgage interest rates? In future episodes, we'll be discussing down valuations, early repayment charges and how to avoid them when remortgaging your property. And we'll be covering off what the term payment shock actually means. So thanks for watching this week. I'm Andrew Overman, and
I'm Michael Webb.
And together we bring you Mortgage Matters. Thank you for watching.
Thanks, Andy.